Welcome to Set and Forget Wealth. In this video, we will explore a straightforward, long-term investing approach designed for 10 years or more. We will focus on simplicity, broad diversification, and the discipline required to let compounding work. Now, let us outline what you will learn. Here is today's agenda. First, we discuss why time horizons of a decade or more are powerful. Next, we build a safety foundation with an emergency fund and high-interest debt elimination. Then, we cover why low-cost index funds dominate and how to allocate 80 to 100% to stocks for long-term growth. After that, we compare lump sum investing with dollar-cost averaging. We will also cover a small speculative slice as an optional satellite. Finally, we will talk about automation, rebalancing, staying the course, and we will close with key takeaways and a short quiz. Let's begin. Long time horizons transform volatility into opportunity. Over 10 years or more, compounding dominates, and the likelihood of positive outcomes increases. The extended runway allows temporary downturns to be absorbed and recovered, while dividends reinvest and growth compounds. With that context, let us first secure your financial foundation before investing. Before any aggressive investing, ensure resilience. First, build an emergency fund covering 3 to 6 months of essential expenses. Next, remove high-interest debt above 7 to 8% because the guaranteed cost of that debt usually exceeds expected market returns. Keep your emergency fund in a liquid, high-yield savings account to maintain accessibility. Once these are in place, you are ready to invest confidently. Now, with the foundation secured, let us look at how to allocate your investments for long-term growth. With a decade-plus horizon, most of the portfolio should target growth through equities, commonly 80 to 100%. The residual portion can be placed in high-quality bonds or cash for ballast. To keep this simple and effective, use broad, low-fee index funds or ETFs, such as total world or total market funds. The emphasis here is on consistency and minimal tinkering. Next, we will compare two execution methods for getting invested: lump sum versus dollar-cost averaging. Lump sum investing places the entire amount in the market at once, which statistically outperforms more often because the market rises more than it falls over time. However, it exposes you immediately to short-term volatility. Dollar-cost averaging spreads purchases over a period, which can reduce stress and help you stick to the plan, even though it may underperform lump sum on average. The best choice is the one that you can execute consistently without second-guessing. Now, before we move on, let us test your understanding with a quick quiz. Question: over long periods, which approach typically performs better on average, lump sum or dollar-cost averaging? Option 1, lump sum. Option 2, dollar-cost averaging. Option 3, they always perform the same. Option 4, neither holding cash is best. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is lump sum. Markets have historically risen over time, so being invested earlier tends to outperform. That said, dollar-cost averaging can be valuable if it helps you stay on track psychologically. Next, let us examine why index funds are the dominant core for this strategy. The single most recommended approach is to use low-cost, broad-based index funds or exchange-traded funds. These provide instant diversification across hundreds or thousands of companies. Importantly, low fees preserve more of your returns as compounding works for decades. By owning the entire market, you secure the market return, which historically outperforms the majority of active managers after fees. Now, to underscore the fee impact, let us look at a quick cost comparison. This table illustrates how small differences in fees compound over long periods. With an assumed 8% gross return, a broad index fund with a 0.03% fee compounds to approximately $93,000 after 30 years. In contrast, a 1% active fund grows to about $76,000. The $17,000 gap is purely due to fees. Consequently, keeping costs low is a powerful and reliable advantage. Next, let us discuss the optional, small, speculative component some investors consider. Your disciplined core belongs in low-cost, diversified index funds. If desired, you may allocate a small 5 to 10% satellite to speculative, high-growth opportunities. This portion carries high risk. It should be treated as optional, never central to your plan. Consistent rebalancing helps prevent the satellite from overtaking the portfolio. Now, let us confirm the suggested range with a quick quiz. Question: what is a commonly suggested maximum allocation for speculative or high-growth picks in a long-term portfolio? Option 1, 1 to 2%. Option 2, 5 to 10%. Option 3, 25 to 30%. Option 4, 50% or more. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 5 to 10%. Keeping speculative bets small helps maintain discipline while protecting the integrity of your long-term plan. Next, we will walk through a simple step-by-step execution blueprint you can follow. Here is your execution blueprint. First, pick a reputable, low-fee brokerage and favor tax-advantaged accounts if available. Second, select your core ETFs, such as Total World or Total Market Funds. Third, decide on an allocation, for instance, 90% stocks and 10% bonds. Then, automate monthly deposits and automatic investments. Ensure dividends are reinvested. Finally, review once or twice per year to rebalance or verify alignment. Otherwise, avoid unnecessary changes. Next, we will visualize a 10-plus year path to keep expectations grounded. This timeline places the steps into a realistic schedule. Immediately, you build the emergency fund and eliminate high-interest debt. During years 1 through 9, you automate contributions, reinvest dividends, and intentionally ignore distracting market noise. Approaching your goal, around years 9 to 10, you gradually shift part of the portfolio into safer assets. After year 10, you implement a strategic withdrawal plan aligned with your needs. Now, let us address how to adjust risk as you near your goal date. Rebalancing once or twice per year keeps your portfolio aligned with the target allocation. As your goal approaches, within 1 to 2 years, you reduce risk by increasing bonds or cash to protect against unfavorable sequences of returns. A rules-based glide path helps you make these changes systematically rather than emotionally. With risk adjustments understood, let us consolidate the central ideas to remember. These are the key takeaways. Time in the market generally beats timing the market. Secure your base first with an emergency fund, and by eliminating high-interest debt, use broad, low-cost index funds as your core. Choose between lump sum and dollar-cost averaging based on what you can implement consistently. If you include speculation, keep it small. Finally, automate, rebalance periodically, and ignore short-term noise. Now, because clarity matters, we will include an important disclaimer. Disclaimer: this content is educational and not financial advice. Investing involves risk, including possible loss of principal. Past performance does not guarantee future results. Always do your own research and consider consulting a licensed professional who understands your personal circumstances. With that clarified, let us finish with a concise wrap-up. To summarize, start by building a safety buffer and eliminating high-interest debt. Use broad, low-cost index funds as your core, and keep a high equity allocation if your horizon is 10 years or longer. Execute through either lump sum or dollar-cost averaging, whichever you can maintain consistently. Optionally reserve a small slice for speculation. Automate contributions, rebalance periodically, and commit to the plan over time. Finally, let us close with a thank you and a request to support the channel. Thank you for watching. If this was helpful, please like the video, share it with someone who might benefit, and subscribe for more long-term investing content. Share your questions and outline your 10-year plan in the comments so we can learn together. See you next time.